Welcome to Dividend Investing Insights, your go to source for all things dividend investing. Whether you are a seasoned investor or just getting started, our channel provides insightful analysis, expert tips, and the latest news to help you build a reliable income stream through dividends. Join us as we explore high yield shares, dividend growth strategies, and portfolio management techniques to maximize your investment returns. Subscribe now and take control of your financial future with the power of dividends. Now, before we go further, and especially for beginners, it is important to know a few terms that we will use during the episode. The first is share. As per Investopedia, a share is units of equity ownership in a corporation. Now, that may sound complex. However, simply put, all large corporations issue shares to public. For example, if you live in the US and own 100 Amazon shares, you are part owner of Amazon. However, your ownership is limited to 100 shares divided by the total outstanding shares of Amazon, which could be in millions. So a share is a unit of equity ownership in a corporation. Now, as you start your investment journey, you need to decide as to what is the purpose of your investment and what is the strategy you wish to follow. Broadly, as you can see on the screen, there are two strategies: value investing or growth investing. Value investing focuses on identifying businesses that are fundamentally strong and have a history of issuing dividends and have the capability to issue dividends in the future. They provide regular dividend growth and share growth. Growth investing, on the other hand, solely focuses on the price increase of the share and is highly risky. While this itself is a vast topic, but for the purposes of this channel, we will focus on value investing. Sometimes in the future, we may do an episode on value investing versus growth investing. The second important term to understand is dividend. Dividend is cash that is shared with the shareholder on a periodic basis depending on the number of shares held by the investor and the dividend announced. As we go through this journey, we will cover terms like dividend kings, dividend aristocrats, and year on year dividend growth. For now, let us limit to dividend being a cash payout made to the shareholder. Now that we now understand shares, we understand dividends, we understand strategy, we now need to identify the shares where we need to invest in. What share should I buy? What will give me high dividend? Is the business performing well over the years? Does the company have the ability to pay in the future? And many other similar questions. So to help navigate this tricky question, we have created a checklist. By following this checklist, you will be able to identify if the share is a good quality dividend stock, and will this be able to give you dividend in the future. Let us now look at the checklist. By following this checklist, you will be able to identify if a share is a good quality dividend share and will this be able to give you dividend in the future. Let us look at the checklist. First and foremost, do you, as an investor, understand how the business makes money? Do you know if this business will have relevance few years from now? If you understand that the business at a high level and you think that this will stay in the future, let us say yes to this and look further. We should now look at if the company regularly pays dividends. Okay. So the second item in the checklist: does the company regularly pay dividend? There are numerous websites that provide this information, and you can easily find if there is the periodicity in dividend payouts. Some companies pay yearly, some half yearly, some quarterly. We should look for consistency to ensure that our payouts are predictable and consistent. More on this later, but for now, if the company is paying regular dividend, we say yes to this and move to the next checklist item, which is what is the dividend yield of the stock for the past 5 years. If a company is consistently paying dividend, we need to look at what is the dividend yield for the current year or the previous year gone by, and what is the average for the last 5 years. The average is quite important as this will indicate the ability of the company to pay dividend at the same rate at which it has been paying in the past few years. Dividend yield shows how much a company pays out in dividend each year relative to its share price. So, if a share price is $10 and the yearly dividend paid out is 50 cents per year, the dividend yield is 5%. Now, assume if you hold 1,000 shares of this stock, that is an investment of $10,000. So, each year the investor will get $500 in cash. You could use this to reinvest or spend on whatever the investor wants. You will find stocks that pay from 0% dividend yield to 20% dividend yield. However, the higher the dividend yield, the more risky it is. So it is important to look at the past few years average. Some advisors suggest to look at even 20 years of history. So, if the potential share has passed these criteria, the next criteria is the payout ratio. Payout ratio is the proportion of earnings paid out as dividend to shareholders. It is typically expressed as a percentage. So, if a company makes $10 million profit and pays out 4 million as dividend, then the payout ratio is 40%. Anything less than 70 to 80% can be considered as a good payout ratio. Companies also need to pay, while the companies need to ensure that the investors are paid, they also need to reinvest in the business to make it grow. So anything between 30 to 80% payout ratio is considered to be good. The next checklist item is the debt ratio. Debt ratio is the ratio of total debt to total assets expressed as a decimal or percentage. So if a company has total assets of 10 million and total debt including loans, operating costs, outstanding amounts of 8 million, that means that the company has a debt ratio of 1.25, which is 10 million, which is the total assets, and 8 million of um, liabilities and all other costs, which means 10 divided by 8, which is 1.25. Anything greater than 1 is considered to be good debt ratio. Now, hoping that we have been able to mark yes to all the 5 checklist items until now for the share that the investor is assessing. The last item is the historical revenue and profit performance of the company. While the CFOs can be quite crafty, but if as an investor you can look at the year on year revenue growth, year on year margin or profit along with debt ratio, you have a fairly good understanding of the health of the company. In addition to this, look at the history of share price, and if you are convinced that this will be a good buy, go ahead and invest. In one of the future episode, we will take up a price to book ratio that will allow the investor to compare the real price of the share versus the market price. Well, with this checklist done, let us apply this to some real shares in the market and see if the shares pass our checklist. The data is as of this recording on 28 July 2024. I personally hold positions in these shares and have been earning dividends in these shares for years now. Now, the companies that we are considering. The first company that we are considering is Fortescue Metal Group, which is a global metal mining company headquartered in Australia. Fortescue is the fourth largest iron ore producer in the world. The company has holdings in more than 87,000 square kilometers in the Pilbara region of Western Australia, making it one of the largest holder in the state, larger than both BHP and Rio Tinto. In addition to iron ore mining, FMG also has a lot of focus on innovation and always trying to find an investment in renewable resources. As an investor, I find that FMG, as an investor, I understand what FMG does to make money and how it will stay relevant in the future. So, as an investor, I mark this as an yes. The other company I'm considering for this sample is Coca-Cola. there would be no person on this planet who would not know what Coca-Cola is. So, without going into more detail, the relevance of business or anything else, let us mark this as a yes. The second checklist item: does the company regularly pay dividend? Yes, both of them do. So FMG, looking up, there are a number of websites that provide this information, but you look at a website like MarketWatch in Australia or Yahoo Finance or any other location, you will be able to find out the dividend history. So FMG pays dividends twice a year in September and March, while Coca-Cola consistently pays dividend every quarter. In fact, Coca-Cola has been paying four dividends a year for more than 25 years, or maybe 50, more than 50 years. It's actually called the dividend king. Now, the next checklist item, which was on the dividend yield of the stock, and again, looking at the websites or the information that is publicly available, FMG has a very strong dividend yield of 10.61% for the current year, and if you look at the 5-year average, it is 10.28%. This is very, very healthy dividend yield, and something that not many organizations offer. Considering if you have $1,000 investment in a FMG at 10.6%, you will probably get $106 as dividend. There is no bank that is paying as a simple as a savings interest or a term deposit that is paying such a significant amount of interest. That, along with compounding, makes FMG a very attractive buy to the users. However, before we conclude, let us still look at the other items of the checklist. On the other hand, Coca-Cola has a lower dividend yield of 2.89% and a 5-year dividend yield of 3.03%. While it may appear low, but what you also need to consider is the share price, which has been consistently growing for Coca-Cola. Now, assuming if somebody had bought this share 5 years ago, where the stock was priced in the early 50s, the dividend yield would, at the same for the same share, would be much more than 3%. It would be more closer to 5 or 6%. But that's a discussion for a later episode, where we talk about how holding to a share for a longer time gives you higher dividend and a higher growth. Payout ratio. Let's look at the payout ratio. Payout ratio for FMG is quite good at 61.6%. Coca-Cola is higher at 76%, almost very close to the border threshold of 80%. However, FMG is good. Coca-Cola is not that good in this example that we are taking as of the current share price. At $67 share price for Coca-Cola, 76% payout ratio is high. It would have been good if it was less than 70%, but nonetheless, this is what it is, and we considered this in our assessment when we complete the checklist. The next checklist item is the debt ratio. Now, both companies are financially strong. They are doing well. FMG has a debt ratio of 2.76%, which is very, very healthy. Coca-Cola has a debt ratio of 1.39. Again, good. And so both of them pass this criteria. Debt is less. They have good operating cash flow, and both the companies pass this checklist item. As I said earlier, any debt ratio greater than 1 is considered to be good. The last checklist item is historical revenue and profit. So while, if you look at it, while Coca-Cola has year-on-year growth in both revenue and profit, FMG does not have so. In fact, FMG has year-on-year depletion in revenue. However, they have grown in profit. This could be due to geopolitical situation or any of the other local factors that are attributing to this depletion. However, Coca-Cola has growth in revenue and FMG has depletion in revenue. Now, what does this checklist tell you? Now, assessing these results, the outcome for me as an investor would be to reassess FMG after some more time, see, probably look at the quarterly results and see if the revenue quarter on quarter is growing, or is it being stable? Is it still affected by the geopolitical situation or the macro business situation? And then make a decision whether to buy it or not. Coca Cola, on the other hand, seems to be a good buy at this time. However, the payout ratio, as I said, is high. The dividend yield, if it was over 3%, it could have been better. However, between these two options, Coca Cola still falls into the category where we could end up buying this stock. And Coca Cola, as of today, is a good buy. So that would be the assessment, and that is how the checklist needs to be used. So, to all those watching this episode, thanks for being a patient listener. Putting up this checklist again, and encourage you to use this checklist and assess shares, and most importantly, subscribe to the channel. Like the episode, provide the comment so that we can be more insightful and give you more insightful videos to you. So until next time, thanks a lot for watching, and see you soon with the next video, hopefully within a week's time. Thank you very much. Bye.